Hi, Joe Rabel again. Coming back to you again, talking about trend. In the last video, we talked about Procter & Gamble. We used a zigzag with just price and analyzed the 1, 2, 3 change in trend, the move that started in the middle of 2018 and really, has been very strong ever since. I took the zigzag off and I wanted to use just the 1840 pattern, moving averages, to show you different things that you can see adding this in as another element. And also show how it confirms what we're seeing with the pure price action. So the same concept holds true when this turns down. We had the lower lows and lower highs in price. Notice how the 18 crosses down through the 40. Both lines are declining. Now, here's the interesting thing. When you're looking at price, you can see, yeah, this had some pretty good velocity to the downside. But when you see it get really stretched away from the moving average, it becomes incredibly obvious that this is an aggressive downside move. And probably not one that can continue at this rate. I mean, when you get this far away, it's very, very difficult to maintain that kind of, again, I use the word velocity, but it's basically momentum to the downside. So we want to be on the lookout for signs where the 18 is dropping at a much faster rate than the 40. And you notice how this bellows out here and the separation is pretty substantial. And then you look down and you see the same concept here. It's the 18 is here and price is way far away. So when I see that, I'm sort of thinking this is not really likely to be a sustainable trend, and the likelihood is we're going to come back. And then you have to evaluate the strength of the rally, because when you get this far away, a lot of times it is more of a climatic situation. That happened to be the case here. You can still, with the moving averages, there's nothing wrong with drawing your trend lines in, but I think a lot of times the moving averages will help define the trend. In this case, that isn't the case, because it was so violent to the downside that it got so stretched away that the trend line was really kind of far away from any of them, either the 18 or the 40. But let's evaluate what happened after it reversed or turned up. We got 18 cupping around, price moves up. And if you remember in the last video, the 1, 2, 3 change in trend took place here based on the zigzags. We broke the trend to the downside. We rallied up. It took a little while for it to come and pull back and make the higher low. And this is where I had pointed out would have been your first sign. This is the 3-point making the higher low. So you made a higher high. So you broke the trend line. You made a higher high. You make a higher low as you turn up here. So what's interesting is when you look at it with the moving averages, it becomes crystal clear, because you have the crossover and then you come in the zone. And as you come out of the zone, this is really the point where you're getting your classic buy signal. Instead of using a moving average crossover, you want to let the moving averages cross over and then look for the first time that you pull into the zone and then come out of the zone. Much safer way to use a moving average crossover rather than being all aggressive, because a lot of times when the crossover takes place, price is really can be very stretched away. Not always, but in a lot of cases, that's going to be the case. So you kind of want to let the crossover take place and then find the first pullback. And we prefer to have that first pullback to take place relatively quickly. I mean, if you get a crossover and it doesn't come in the zone for a while, let's say it goes 6 months on a weekly chart, by the time it comes in, it's probably more of the end of the move rather than the start of something. But let's go back and evaluate. The 3 things we really want to look for are the direction of the trend, the strength of the trend, and the longevity of the trend. And using the moving averages, it becomes very, very simple. What you're trying to find, as opposed to this big separation here where you get the 18 falling at a much faster rate, notice what takes place when we turn and has been taking place. I mean, you literally could draw a straight line on this trend line and a straight line here, and they look parallel. This is your classic pattern on a higher time frame where you want to look to buy pullbacks, when you have an 18 and a 40 that are running at a comfortable distance, where there's just a comfortable distance between them, they're not separating, going crazy. The 18 isn't losing strength. It's just continuing to climb at basically the same rate, almost at a 45-degree angle. And then you have the 40 doing the same thing. That is trend. This is the type of trend, and I don't even need to look at an indicator when I'm doing it this way. If I'm looking at the 18 and the 40 and I see this type of parallel line look, you really want to be a buyer on pullbacks. We're going to get into multiple time frames in depth and go into all the different patterns and what you want to look for, the detail in terms of the lower time frame. But on the higher time frame, if you focus your efforts on stocks that have a very strong trending 18 and a 40 that's going at about the same rate, your probabilities of success are going to go way, way up.